At 8:31 a.m., the markets open. Nothing has exploded. No law has changed. No central bank has spoken. Yet within minutes, oil prices tick higher. Gold attracts buyers. The U.S. dollar strengthens. Airline stocks begin to slip. Government bond yields start moving. One headline: billions of dollars. How? Because in today's economy, markets don't wait for reality. They react to possibility. And lately, one question has become impossible for investors to ignore. Can the United States still absorb another major economic shock from the Middle East, the way it once could? Because 20 years ago, the answer seemed obvious. Today, the math is very different. The United States is still the world's largest economy. Its financial markets remain the center of global finance. The U.S. dollar is still the currency that much of the world trades, borrows, and saves in. On paper, America looks financially stronger than almost anyone else. But balance sheets don't lie. Behind that economic strength sits another number: more than $36 trillion in federal debt. That's larger than the entire annual economic output of the country. For years, this wasn't viewed as an immediate problem. Interest rates were historically low. Borrowing money was relatively cheap. Governments could finance spending without feeling much pressure. Then, inflation arrived. Central banks raised interest rates. And suddenly, yesterday's cheap debt became today's expensive obligation. Today, the U.S. government spends hundreds of billions of dollars each year simply paying interest on money it has already borrowed. Not building roads, not funding research, not investing in future industries, just paying interest. And that's where this story really begins. Imagine owning a successful company. Sales are growing. Customers keep coming. Your business is profitable. But every year, a larger share of your income goes toward paying old loans. Eventually, you face uncomfortable choices. Delay expansion, postpone hiring, cancel investments. The company isn't failing. It's becoming less flexible. Governments experience something surprisingly similar. The more income devoted to servicing old debt, the less flexibility remains for unexpected challenges. That's why economists don't focus only on how much debt exists. They focus on how expensive that debt has become. Now introduce energy. Modern economies run on it. Cargo ships, passenger aircraft, factories, farm equipment, data centers, delivery trucks. Almost every product touches energy at some point before reaching a customer. When energy prices become unstable, costs begin spreading quietly across the economy. Transportation becomes more expensive. Businesses pay more to move goods. Manufacturers face higher production costs. Retailers eventually raise prices. Consumers notice inflation weeks or months later. It's like dropping a stone into a lake. The first splash is small. The ripple reaches everywhere. Here's something many people misunderstand. Higher energy prices don't automatically create economic problems. The real danger is uncertainty. Businesses hate uncertainty. Imagine you're running an airline. Should you lock in fuel prices today or wait? Imagine you're opening a new factory. Do you invest now or delay 6 months? Imagine you're a bank deciding whether to finance a billion-dollar project. Do you approve it or become more cautious? None of those decisions make headlines, but together they shape economic growth. Then another chain reaction begins. Suppose inflation has finally started cooling. Consumers are feeling optimistic again. Businesses begin investing. Markets expect lower interest rates. Suddenly, energy prices rise. Inflation expectations start climbing again. Now, central bankers face an uncomfortable decision. Cut interest rates and risk inflation returning, or keep borrowing costs high and risk slowing the economy. Neither choice is ideal. Financial markets understand that immediately. Bond yields adjust. Stock prices react. Currencies move. Not because anyone knows the future, but because everyone is trying to estimate it before everyone else does. This is where America's debt changes the equation. When borrowing costs rise, refinancing existing debt becomes more expensive. Future spending becomes harder to finance. Interest payments consume a larger share of government revenue. Economists call this reduced fiscal flexibility. Think of it like carrying a heavy backpack. Walking is still possible. Running becomes much harder. The world's largest economy can still respond to unexpected challenges. The question isn't capability, it's cost. History offers an interesting perspective. Financial markets have experienced many periods of geopolitical uncertainty over the past several decades. Sometimes oil prices surged. Sometimes they barely moved. Sometimes markets recovered within days. Other times, uncertainty lasted much longer. The difference usually wasn't the headline itself. It was whether investors believed energy supplies, trade routes, inflation, or business confidence would face meaningful pressure. Markets care less about drama. They care about consequences. Meanwhile, companies quietly prepare for multiple possibilities. Manufacturers diversify suppliers. Shipping companies review logistics. Investment firms hedge risk. Banks reassess lending standards. Technology companies delay certain investments. Energy producers watch futures markets almost hour by hour. Each individual decision seems small. Collectively, they influence employment, productivity, investment, and long-term growth. Confidence isn't just an emotion, it's an economic asset. There's another hidden cost that rarely receives attention. Opportunity cost. Every dollar spent servicing debt is a dollar unavailable somewhere else. Artificial intelligence, semiconductor manufacturing, infrastructure, scientific research, education. Modern economies constantly compete for future growth. Money directed toward one priority cannot simultaneously fund another. That's why economists often ask not only, how much will this cost, but also, what won't happen because those resources were used here instead? Sometimes the invisible cost is larger than the visible one. Ironically, financial markets rarely wait for certainty. By the time events become obvious, investors have often been adjusting portfolios for days or even weeks. Money flows into safer assets. Businesses revise forecasts. Commodity prices shift. Credit markets reprice risk. The economy begins adapting before most people realize anything has changed. That's one of the strange realities of modern finance. Expectations can influence behavior long before reality catches up. So perhaps the biggest question isn't whether the United States remains the world's strongest economy. It does. The more interesting question is whether strength means the same thing it did 20 years ago. When debt is larger, borrowing is more expensive, and uncertainty travels through global markets in seconds instead of weeks. Economic power isn't measured only by what a country can afford to do. It's also measured by how much flexibility it still has after paying yesterday's bills. Because in today's world, the most expensive part of any global crisis isn't always the event itself. Sometimes, it's discovering that financial flexibility is far more valuable than anyone realized. And once it's gone, how do you put a price on getting it back?